Hey there, financial freedom fighters. This is Alex Mahoney with Coda Financial Coaching. And today I wanted to walk through the Vanguard S&P 500 Index Fund. Now, I just threw a lot of terms at you guys here. So let's first go through why the S&P 500 Index Fund, why it's so important to know about that on your journey to financial freedom. So if you're familiar with the Ramsey baby steps, baby step number 4 is setting aside 15% of your income for savings and retirement, right? So that is a really important step on the way to being happily retired and having everything you want in your retirement even before then. And one of the ways to achieve that is a well-diversified, well, actually, it's really the only sure way to achieve that is a well-diversified portfolio. And the S&P 500 index is so important because it does provide that well-diversified portfolio. Now, well-diversified, that is just fancy language meaning that there's a lot of different stocks from a lot of different industries. So if one stock is not doing well because, I don't know, because, right now Tesla, it's been all over the news that the sales of their cars are slowing down. They're having to cut prices. Their margins are going down on each car, and they're basically not as optimistic. It's not the same growth mode company that it was 10 years ago. It's not the same level of excitement due to competition and other economic factors. But there's other stocks within that diversified fund that are going up. So you're never going to be completely out to sea because you invested all in one stock. So a well-diversified portfolio is really important in that Ramsey baby step number 4, getting that 15% of your income saved away, and you can sleep at night knowing that it's not all going to be lost because one stock or one ridiculous Bitcoin, which I do not recommend, by the way, goes to complete crap. So now that we've gotten that out of the way, why it's so important to know about something like the S&P 500 fund, let's get into some of the other terms that I mentioned. First of all, Vanguard. Vanguard is a big investment house. It's really the biggest, it's the most famous, and it's the one I recommend to all of my clients. And they have a bunch of different investment options. If you know you can invest more than just your employer's 401k, or maybe you don't have an employer 401k, Vanguard is really your best option in terms of fees and the number of investment it offers. So, okay, getting into the S&P 500 index, what does that mean? So all that is a collection of the 500 biggest companies in the US, and it weights the value of those companies both in absolute terms, just how much each company is worth. And it also weights the relative value of those companies within that. So in other words, if Apple is just killing it and going way up, it's going to have a bigger share of those 500 stocks within that index fund than other companies are, right? So it's going to take up a bigger piece of the pie, and it's going to grow the pie. So really important to know about all that. And then ETF, final thing. ETF, don't get, it sounds like a super technical term. It's really not. All it is a collection of funds, whether it's pegged to a index fund or index, just like I talked about, or if it's a assortment of stocks that are chosen by a stock professional or a market professional. All it is a bucket of funds, and it is traded, it's managed by professionals, or it's pegged to that index, and then it's traded on the stock exchange, right? It's traded on the NASDAQ, whatever stock exchange, New York Stock Exchange that you use to buy and sell stocks. You can go and get it on Robinhood or whatever, right? So that's all it means. Don't get freaked out by that term. So anyways, now that we have those introductions set, and we're at that Ramsey baby step number 4. We want to start investing, right? We want to get in. We've paid off all our debt. We have that emergencies fund, or we've paid off all our debt except the house. We have that emergency fund, and now we're ready to save. Now we're ready to get into actual stocks, be owning the same stocks that make corporate executives rich. By the way, that's how corporate executives, they get stock from working for those companies. And even though, unlike them, we do have to pay for it, we don't get options like they do. You know, we're just a little guy right now. But at least once we do get to get that stock, we get to enjoy the same benefits in terms of growth and dividends that they do. And we may not become Elon Musk or Bill Gates, but if we really stick to a well-diversified portfolio and we invest in that early, we're going to be pretty good by the time we're 60, 65, around that retirement age. So anyway, I want to get into what is actually in there. Let's go under the hood of what's in this S&P 500 fund. So what I have here is a Morningstar. I'm a big Morningstar fan. Basically, Morningstar is just an analysis of stocks, right? They have articles, they have all sorts of stats about both stocks and mutual funds and ETFs. Right now, we're going into ETFs because really ETFs are usually the cheapest way to get a well-diversified portfolio here. So, of course, there's a bunch of other ETFs, but we want to track the one that's really the gold standard because the market itself, which the S&P 500, of course, by its definition, it's meant to reflect the 500 biggest publicly traded companies in the U.S. It is, by definition, a reflection of the market. And very few people outperform the market in the long run. We don't have to be Warren Buffett. We just have to know what this is and what an S&P 500 ETF fund is and how to analyze it here. So there's a lot of information here. Just making sure I'm on the right page here. Okay, give me a second here. So yeah, okay. So I did go to the right page. I want to make sure I'm actually showing you guys, what you need to see here. So this is Morningstar's basically summary of the S&P 500, and there's a lot of information here. And if you guys want to jump in the comments and really, ask what some of this stuff is that I'm not going to really go over and talk about, please do so. I want to know what you guys are curious about, but I'm going to go over, to me, what I'd be looking at if I knew nothing about the S&P and I wanted to know how much money am I going to make on this, what has been the historic performance, and how much is it going to cost me. If obviously there's somebody making money off of this, I want to know how much they're taking off the top. So speaking of which, this is the first thing that I really like. I guess I'm kind of I can be kind of frugal, right? Like I want to know that I'm getting bang for my buck with my my ETFs that I save for. So I go to this adjusted expense ratio. So what this is this is the amount of money that's basically spent on all of your brokerage fees, all of the marketing of this fund, all of the admin, and all of the management. And this 0.03%, guys, that is extremely low. Honestly, I don't think any ETF gets lower than that, right? And the reason is because the managers here, they're not really managing anything. All they're doing is following an index that is already propagated by Standard & Poor's, right? They're literally just, okay, Standard & Poor's, they just brought in this new stock because it grew into the top 500 companies. We're going to do the same thing. They're not saying, which company is going to be the next big hottest thing that is only worth $1 now, but we know it's going to be worth $100 in 5 years. They're not trying to do that. They're strictly following the market, which, as I said before, very few people outperform the market. Pretty much nobody outperforms the market in the very long run. So that's a really good thing we like to see here, that 0.03%. And guys, if you see anything really, especially if you're a beginning investor and you're not really into this stuff and you don't have a clear vision for what sorts of stocks you should be owning, really, we should never go above 0.15. There's no reason to go above an expense ratio of 0.15. I could even argue to be more conservative and say that number should actually be 0.1%. But here, 0.03. Okay, great, right? Okay, so now we go to the price of the fund. Now I'm just going to point this out, and this actually, guys, isn't as important really here. Really, this is just Vanguard's way of dividing up a share. It can slice and dice that share among I think it has it somewhere here about how many assets are under management in this fund. But oh yeah, here it is, 980 billion. All that is however many shares Vanguard decides to slice and dice it by, divided into this number. So really, sure, this is kind of fun to look at, but really we want to see the movement within. The price is not as relevant. We want to see the returns on this, right? So let's get in, before we get into some of the stats, I want to get into Morningstar's analysis here. So right here, Vanguard S&P 500 Index offers a broadly diversified, low turnover portfolio of U.S. large cap stocks at a minuscule price. So a lot of that is what I was saying, that minuscule price being the 0.03 expense ratio, and broadly diversified meaning that you have 500 different stocks in there, large stocks that are not anywhere close to failing usually. So, and then one thing I didn't mention, low turnover. What does that mean? Low turnover means that there is not a lot of the managers of this fund aren't constantly buying and selling out of this fund in order to pursue some sort of aggressive strategy, right? They're pretty much, they say, okay, if it's in the S&P 500, we have it in the portfolio. If it's not, it's not. What you really want to avoid are funds that are, if you see something like a 20 to 30% turnover portfolio, that means that the fund managers, they can't decide what to have in there, right? They're constantly chasing the next biggest, shiniest object. And that means they don't have confidence in their original decisions, and they're suddenly changing, trying to chase returns. And usually that leads to bad results, guys. We want to see a fund manager have confidence in the choices they've made, whether they're following an index or they're not. Okay, let's move on. This strategy replicates the flagship S&P 500, which is a market cap weighted basket of about 500 of the largest U.S. stocks. All right, so, I've already kind of explained that, right there. Rather than index rules dictating construction, an index committee has discretion over selecting stocks that meet certain liquidity and profitability standards. So there is a little bit of, choosing high quality stocks to go into that top 500 stock price or number of stocks that are in that index as well, right? So, all right. U.S. large cap stocks attract liquidity and widespread attention such that new information is quickly reflected in prices. In other words, that's going back to our liquidity. These are well-known stocks, right? And there is one warning right here. However, market cap weighting may expose the index to significant stock or sector level concentration during the market's intermittent manic episodes. So what this means, guys, is that you can have one stock within there just go absolutely bonkers. I think like Tesla, what was it, 2021, like doubled in price. Like Apple has had its just doubling in price. And what that means is it can become such a huge part because it's already such a big company and it starts growing so quick. It can become such a large part of that index fund that maybe something like 15 to 20% of that index fund can be in one stock. But typically that's not the case. Stocks come down to earth, other big companies rise while that stock falls. So as Morningstar points out, usually in the long run, the benefits of diversification and the other aspects of the fund do win out there. So, those are just some like highlight things I wanted to point out here. All right. So let's get into, some of the nitty gritty here of how the S&P is done. So right here, basically they take a 10-year horizon, and they show you if you had invested $10,000, what would have, what would have you got? What would you have now? And that includes reinvestment of dividends right there. So, right. So what you can see here is it's a pretty good trend line up, guys. Obviously, there, since 2014. Obviously, there's a dip. Right there is the COVID dip right there. But then it's pretty consistently up, into, so that means we've been in more or less a bull market since, it doesn't go back before, but we've been in more or less a bull market since 2009. That's a pretty dang good run right there, right? Okay. Down here, we see the return each year. And we can see here that, the investment price, this is really what we want to be looking at right here. This is our return. So most years, we've had a pretty good run as well. Just a couple, 2022, we had that inflation. 2020, obviously, we had a bit of a downtick because of COVID, but then it rapidly went back up. So far, obviously, we're not that far into the year, but it's gone up 1%. So pretty good returns here, right? And here's something that is really important here too. Percentile rank. This is comparing it to other ETFs, right? So this may not look really good, like, oh, it's only, if we look at this average, just kind of ballparking it here, we've been in the top 25 to 35% of index funds in any given year, right? So, that doesn't sound that good, right? Well, maybe not that good. But if we think about it, guys, if you kind of zoom out, to be year after year in the top 25 to 35% and know year in and year out that this investment, without having to do much analysis, without having to think about it at all, is consistently within that 25 to 35%, that's pretty good. And you can actually see here, if we go down to the trailing returns, and this may seem a little bit confusing, but even though the average of the returns have been for any given year have been like 25 to 35% in the percentile rank, we can see in the 10-year, over the 10-year timeline, that actually it's been in the 10th percentile. In other words, it is performing better than 90% of investments, right? So how is that possible? Like, the average is, clearly in the 25th to 35th percentile rank within any given year, but over a 10-year time frame, it's in the 10th percentile. Well, really easy, because yes, there are some funds that are highly specialized in certain sectors, and some years they'll just knock it out of the park, right? They'll be in the 1%. If you invested in that year, you would have like doubled, maybe even tripled your money. Who knows, right? But then in some years, they perform so poorly that they get knocked down to maybe they're in the 80th or 90th percentile. Like, think if you had invested in, I don't know if this actually exists, but an electric vehicle ETF in 2021, you would probably be like tripling, quadrupling your money. Versus last year and this year, guys, you probably would have lost like all your money, if not all of it. The electric car market not doing so well right now. So that's why, because there isn't a lot of volatility, and because it is the tortoise racing the hare over a 10-year period, that's why over 10 years, it is your best bet right there, right? So we want to actually look to that 10-year horizon right there. So, okay. Just some other things to look at here, guys, before we get into actually what's inside. The risk score. You can see here that it's aggressive. Now, aggressive, if we should take aggressive with a grain of salt, right? Maybe we call ourselves a conservative investor, right? But let's say we're 25 years old and we've gone through the Dave Ramsey baby steps, 1 through 3. We're ready for number 4. and we can consider ourselves conservative, right? It actually, even though it's called aggressive, and that may be true as compared to a bond or as compared to a CD or a government treasury, actually, guys, over the long run, investing in the S&P is pretty moderate to conservative, because we know from history that over any 40-year time frame, which if you start investing at 25 to retirement, it's going to be at 40 years of returns, right? That's actually pretty, you're pretty much guaranteed to make money there, assuming that you're rebalancing as you get closer to retirement. But that's a conversation for another video here, right? So yes, it's aggressive, but for somebody that's 25 who knows that over any given 40-year period, they've always won with the S&P, it's actually fairly conservative. I would call this extreme category being like you're investing in an ETF, and there are ETFs that do this, but you would invest in an ETF that is solely dedicated to Bitcoin and crypto coins. That would be aggressive. I do not recommend that. I don't recommend you get into Bitcoin at all, but that's another story. We'll probably have another video why that's a terrible choice. So, getting more into here, basically, yeah, we have more of our price ratio here. Let's get into our portfolio here. So I think there's actually a section where we can see what's in here, right? Now that we've seen the returns, we want to actually see what's in here. So first we'll break it down by sector right here. You can see here basically all of these different industries here, and it's interesting that Vanguard kind of classifies it for you by, or not Vanguard, I'm sorry, Morningstar classifies it for you by what type of investment it is, and cyclical, sensitive, and defensive. So it's going through all the sectors of the economy, and it's classifying them into 3 different branches right here. Cyclical. What that means is it goes through booms and busts, right? Depending on, like, for example, something that is in construction, real estate, heavily involved in construction, basic materials, heavily involved in construction. If you think of the construction industry, everything built from that, it is highly cyclical. We go through boom periods, we go through bust periods. It really follows the cycle, the business cycle of the economy. That doesn't mean it's good or bad, guys, because it does well sometimes, it doesn't do well other times, but in the end it's going up. All it means is it's following the greater economy. It's part of your diversification strategy. Sensitive here. What this means is it is very sensitive to basically market inputs and economic conditions, right? So it's going to really go up or really go down based on how the economy is doing. So technology is kind of the best example. Technology in the past, I mean, really, let's face it, except for 2000, technology has been the biggest winner since the 1980s right here. And not surprisingly, it is the biggest part of our portfolio. However, if there is something like an inflationary shock, or if there is a supply shock, for example, that we saw with the chips, with semiconductors and chips that we saw in 2020, basically 2020 through 2022, we're still kind of coming out of it. We can see prices getting hit pretty badly. Now, conversely, if we see conditions of low inflation and easy money, technology, it's highly scalable, so it can go up. So sensitive, all it means is that it can go way up or way down based on economic conditions. Whereas cyclical, it basically more or less follows economic conditions. If the economy goes up 10%, it's kind of a good rule of thumb, I can't talk, that like all of these will more or less go up 10%. Whereas here, if the economic condition, maybe inflation went up 8%, technology could sink by like 20, 30% or something, certain technological stocks, right? And finally, defensive, Defensive means that basically no matter what the economic conditions, these are your real workhorse, tortoise. People are always going to need, for example, utilities. They're always going to need healthcare. They're always going to need, to go to the grocery store. So basically, these are your rocks. The only bad thing is there's not a lot of upside to them. It's not like people need to go to the grocery store 10 times more if the economy is booming, right? They don't need 10 times more electricity if the economy is booming. So they're really your true workhorse tortoises. And once again, none of these categories are good or bad. They just have certain disadvantages and advantages that offset each other and that really underline that diversification that you have in that portfolio. All right, so let's get down to the juicy stuff here, right? We have our holdings right here. So you'll notice Apple Inc. It comes in, it is 7%. If we remember that up here, this 400, where is it? The stock price here. 445, well, that's the opening price today. So we're actually at 449 right now. That means Apple is 7% of that. Now, even though I'm a financial coach, not always good at math, but I'm just ballparking that. That's about $33 of that is in Apple. That's huge for having 500 stocks for Apple to be that much in it. But it makes sense because once again, as I said before, we're talking about the relative value between these, not just the absolute value of these stocks, but the relative value between all these stocks. And Apple is such a behemoth that in order to properly reflect its position in the market, at any S&P index fund, any index fund that holds it is going to have a huge portion of it. Not surprisingly, we see some of the other big, well-known companies too. Microsoft, Amazon, Nvidia has been a very hot one, and we can go down the list right here. So basically everything, the really, interesting thing is basically just doing the math right here. I'm just ballparking here, 14, 17 and a half. It's about 20, 22, 24. So basically, guys, we have 7 stocks making up 25%. And yeah, that may seem concentrated, but these are all great, well-established companies that are just, killing it in the market. They're probably not going away anytime soon. And if they do start to fade, the nice thing, guys, is that other companies will rebalance and become a bigger part of the portfolio. See, the rebalancing is automatic. So I wouldn't worry so much about that concentration. You have access to companies that have made a lot of people rich, and just be thinking about that. And of course, we have a bunch of other companies too. All of these are household names, guys. And all of these right here, and I don't know if they do have the sector right here. You can see what sector they're in. And that ties back to this. So if we don't want to go through and learn about all these companies, guys, really the important thing is to know what sectors are represented in here and know that we are well diversified across the entire economy right here. So that's about it for today, guys, that I wanted to get into the S&P to show you what's, the S&P 500 Vanguard Index Fund, to show you what's in it, to really give you a good overview of why it's such a good investment, especially for a baby beginner investor that wants to sleep at night and wants to know that their investment is going to be safe over the long term here. There's a lot of other stats in here that you may have seen. If you want to jump in and comment about something you want to do a deep dive in, please do so, guys. I'm happy to get into this in detail. But that's all for today, and I will see you soon.